Hey everybody, welcome to Mortgage Today for Monday, September 25th, 2023, and oh, what a day it was. Ouch, tough day. UMBS were down a big 39 basis points in the morning. S&P futures were down 10.5 points as traders returned to their desk following the worst weekly sell-off in Wall Street since March. Most of the weakness arrived in the overnight session. It is largely a gradual affair. Yields were only slightly higher in Asia and still under Friday's highs at the start of European trading. Europe, however, added to the selling pressure more abruptly on slightly stronger data, ECB comments, and oil price concerns. U.S. traders jumped on the dog pile after comments from Fed's Goolsbee on the utter commitment to the 2% inflation target. In other words, a persistence of rate hikes or holding rates at higher levels in pursuit of the target. The government shutdown may linger as a background concern as government spending tends to increase after shutdowns end. And we also have the UAW strike, which is also a consideration as a supply constraint that pushes vehicle prices higher, aka inflation higher. In response to the Fed's hawkish words, the Optimal Blue 30-year lending rate closed at 7.3% on Friday, the highest level in at least half a decade. After the salvo of central bank decisions last week, traders are increasingly concerned that rising oil prices risk fanning inflation, which will make it difficult for policymakers to reduce rates anytime soon. Oil resumed a rally as hedge funds piled on bets tightening supplies will stoke demand. Markets also not yet convinced the Fed will truly take rates higher and hold them there longer. When the markets actually start to accept this and price in the reality, we will see mortgage rates move higher, although a true recession is likely to come at some point. It won't be for quite a while if it does, though. In the meantime, we aren't likely to get any help from any data for the rest of this month, and I don't think October's jobs data next week is going to be much more helpful. Bonds began the week with another move to long-term high yields. There was a wave of selling in the overnight session led by Europe and another when domestic traders ramped up the day. Neither were unequivocally the product of some data or news headline, although there are a few scapegoats that can be mistaken for motivation. The problem with said scapegoats is that while they likely contributed, they're not nearly meaningful enough to justify the movement in question. Conclusion: this sort of selling is broader and more sentiment-driven. Traders are repricing higher for longer odds with the longer end of the yield curve. Buyers are on strike until something convinces them to buy, and that will be hard to do unless next week's data is weak. MBS closed the day down 40 basis points at 98.96 on the 6%. So at 98.96, we are right in the middle of this big wide range with a ceiling at 99.7 and a floor down at 98.944. So these wide ranges tend to be bouncy, as you can see from the tall candlesticks going on right there.